$50 silver, I think, in the fullness of time, will eventually become major support. And I think we go much higher than that. How high? Pick your number, but I think it's a lot higher than 50. But hey, let's get to 50 first. I think a lot of us who've been in this for a long time, we'll be happy when we get to 50.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 20th through January 27th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm glad to invite a returning guest back to our studio. We have Steve Penny. He's the founder of SilverChartist.com. He joins us regularly to talk about movement in the major markets. And Steve, thank you for joining us again this Friday, January 24th, 2025.
You bet. Thanks, sir. Really appreciate you having me back on and look forward to a good conversation.
It's been a rather eventful week in the U.S. with the starting of the Trump presidency this Monday, his first day of swearing in, and then his first full days in office, 1, 2, 3. This is the end of the first week, and we'd love to get your view of the markets and how they've been reacting this week, as well as the major trends that you're seeing. If we could maybe hit gold right up front, and then talk to us also about the gold, the miners, and then we can talk about silver and uranium. So if you could kick us off first with what you see going on in the gold market and what we need to be keeping an eye on.
Sure, yeah, big picture. I like to start with fundamentals, and then I like to say fundamentals tell me what to buy, and technicals tell me when to buy or when to sell. And the fundamental backdrop for gold really is as bullish as it's ever been. I'm more bullish on gold now than I've ever been from a fundamental perspective. Now, that's beginning to be reflected in the price as other people are waking up to these realities that people like you and I have been talking about for a very long time now. And, a lot of people, I think maybe were overly optimistic that, this new president is going to come in and, fix our fiscal and monetary situation, which I think, the market is telling us that they're not buying that. Yes, this Doge committee, maybe they'll find some spending to cut, but at the end of the day, the top four expenses of the federal government consume 100% of federal tax receipts. And nobody's talking about cutting any of those things. No one's talking about cutting Social Security, Medicare, or Medicaid. Interest on the debt isn't going down anytime soon. And defense spending, those handful of things consume all of our dollars. And I think those are things that every single investor needs to wrap their mind around, that their problems have solutions, predicaments have managed outcomes. And there's really not a solution to this problem, barring some kind of like productivity miracle. So with that backdrop, I see gold, you would have thought maybe it would sell off a little bit more based on this narrative that, hey, we're going to cut all this government spending and things are going to start to improve fundamentally. Well, gold has hung in there and has been very resilient. In fact, today as we're talking, it's just a few dollars below that previous all-time high of 2,800. So with that said, I can go ahead and share my screen if you like.
Please, go ahead.
So whenever I look at charts, I like to go big to small. So this is a longer-term chart of gold. And this pattern, we've been talking about this for a long time. This goes back over 10 years. And whenever you have a pattern like this, there's two ways to get a measured move target. You can flip the big cup portion or the handle portion. And either one gives you a measured move target of either 3,000 or 2,500. Well, that's what we're saying at the end of 2023. Well, we got up to 2,801. So we've largely hit that measured move target right between 2,500 and 3,000. I am very bullish on gold over the longer term, but I think the risk reward over the shorter term is not nearly as favorable as it is for silver. So what do I mean by that? I think over the short term here, the next couple months, few quarters, yeah, maybe there's a few $100s of upside, but downside risk also is about equal. So that's about a 1-to-1 risk reward ratio. So as a trader, as someone who's looking to maybe make some money short term, I think there's better opportunities than gold. However, as someone who's looking to buy insurance as a generational insurance policy for my children and children's children, if I didn't own any gold, I would want to rectify that right now. When I look at the daily chart for gold here, this is more of a shorter term time frame. Get that dialed in for you guys, just like that. So you can see this yellow line is the 200-day moving average. Whenever you have price above a rising 200-day moving average, that's bullish. And those institutional money and those trading algorithms tend to be in a buy the dip mode whenever you're above a rising 200-day moving average. So we've seen that with price above this rising 200-day, dips are being bought. And the next thing to look for would be a higher high above 28.01. That's the recent high from back in October, 28.01. So that's a number to kind of maybe commit to memory if you're someone who's trading gold, because a break above that would be very bullish, especially on a weekly basis. Let's see if we can close above there today. So that's kind of the resistance level to watch on gold. If you're someone who's looking to buy pullbacks and, hey, I've already got a core position, I'm looking to scale in, but I want to kind of be patient, this $2,500 to $2,550 area would be a very compelling entry point to scale in a little bit, because you've got a confluence of support right here, and that's right where the 200-day moving average is. Now you might say, oh, these are just lines on a chart. Not you, but some people might think that. I used to think that. Well, the fact is that these technical patterns really do matter because the big money uses them and the institutions use them. So those are some kind of key levels to watch: 28.01 on the upside and $2,500 as support.
I noticed on this chart that the view that you're showing us, the election day, the drop after the Trump election is quite evident on there, and then the recovery back up to almost surpassing the previous high that had been present prior to that. It's interesting as we look at all the various factors that are driving supply and demand on gold, that the unrelenting accumulation of gold from foreign central banks continues. And now we're having, as you mentioned, perhaps some awakening on the part of people who thought maybe we were into kind of a relief of all concerns mode, that there's still reason to realize that you have to protect yourself against government overspending and overdebting and that sort of thing, that the debt crisis hasn't been resolved. And what was the quote that you gave on that? That was really an interesting quote that you said. You said problems have...
Yeah, problems have solutions. Predicaments have managed outcomes. So I don't really see a solution to this problem. People are looking for the solution. Well, there really isn't one. I mean, unless you're willing to go through extreme pain over the short term, because we've made profligate mistakes, with our fiscal situation. So unless they're willing to tell grandma and grandpa, hey, sorry, we're going to drastically cut Social Security. We're going to cut Medicare. We're going to cut all these, all these crazy things the government does. Some may be good, some may be bad, but it would require pain. We know they're not going to do that. Politicians never do that. And these are just cycles that repeat through history, right? Governments expand beyond what the tax base can support. So what do? They debase their currency. It's just a cycle that repeats over and over and over again. And silver and gold always do a full accounting for that expansion of debt-based fiat currency. That's just what they do.
We're grateful for your keeping an eye closely on the movements in these charts. Now, at the same time that gold has been performing remarkably over the past year, the miners seemed less so. You've kept an eye on various aspects of that. Can you bring us into focus on that?
Sure. GDX is a good proxy for just large cap gold miners. So this is a long-term chart going back to 2008. And you can see, even though we're sitting here right near all-time highs in gold, well, the price of this ETF is about half of where it was back in 2011. So these mining stocks make very poor investments. However, they can make very good short-term speculations because they're volatile. The thing with mining stocks is, I remind people, whenever you push the buy button, you have to have a subsequent plan on when to push the sell button. These don't make good things to just sit and hold for 10 years. As you can see, I mean, price of gold has gone up, but the mining stocks have gone down. So you have to have a plan how to use that volatility to your advantage. And that's where I think technicals can give a really nice advantage because the institutions look at them. So we just talked about the 200-day moving average in gold. Well, the mining stocks they lost 200-day moving average support, and now they're just fighting right here. I'll zoom in for you guys a little bit. Right here, that yellow line. Let's see if we can hold above that rising 200-day moving average. Those are some key levels to watch in GDX. The 200-day moving average, then you've got big support down here at 33. This goes back quite some time. You got this gap here, horizontal support. So what technicals allow me to do is make if-then statements. So if price pulls back to 33 and is oversold, then I will scale in. If price rallies up towards, say, 44, well, then I'll take partial profits. And that way, I'm not relying on, I'm putting on, I can be a profitable trader whether things go up or down. You can use volatility to your advantage. That's how I'd think about these mining stocks, not as just a buy and hold investment.
Just a curiosity question. In equities for which there's quite a bit of volatility, do you ever do any, where you're holding the equities, do you ever sell covered calls, for example, to regain some of that time premium that just benefits from the fact that you're watching volatility over time rather than hoping that it'll go this way or that way, be able to recoup some of that on a time basis?
Yeah, occasionally I do. I maybe make 3 to 4 options trades per year, and I like to trade options when things are at like extremes. And I'll just give you an example here. Now, I didn't do this, and I'm kind of kicking myself, but I kind of wish I did. My two biggest like core long-term holdings in the precious metal space are Wheaton Precious Metals and Agnico Eagle. Those are just two I like. There's a couple other ones, but these have like performed as you might expect. Gold and silver are rallying. Gold's making new all-time highs. Well, what did Wheaton Precious Metals do? It made a fresh all-time high. Agnico Eagle's right up there too. So here's a longer-term chart of Wheaton Precious Metals. So up here, we had gotten extreme overbought in multiple time frames, and the stock had gotten ahead of itself. So like you said, an option for someone who wants to hold that core position would be to sell calls. And a lot of people, the vast majority of retail people, they buy calls. And the vast majority are wrong. But the seller, it's like, I'm not a gambler. I don't like gambling, but to use the analogy of like, you become the house when you're the seller of the call. So you can rent out your shares and get income for them. Sorry, that was probably a long-winded answer and divergent, I didn't mean.
No, I think that's actually educational because many people don't realize that when they're holding something that's has gone up quite a bit in value and they don't want to sell it outright, but they would like to make a continued yield on it, that you can sell covered calls against something that you own, like shares in a company, and be paid for just putting the offer out there. Basically, you're saying, if it were to go up further, I'd be willing to sell it at the current price or something like that, and get paid to make that offer. Even if it never gets acted upon, you still get to keep that premium.
That's correct. Yeah, that's exactly right. And people do it at the wrong time too. To me, like I said before, extremes. You can see this RSI up here. So this would have been an ideal time to sell calls. And another important thing with that is, if you sell your shares, well, that creates a taxable event. And then if you go buy them back, well, now you reset your
basis.
You want to preserve your long-term capital gains basis. So, to get long-term capital gains treatment, you need to hold those shares for over a year. Well, if you're constantly buying and selling, you're likely paying short-term capital gains, which is higher.
Fair enough. In addition to the miners, you're also watching silver, and you had mentioned earlier that you're actually more excited about silver's prospects than gold's in the short term because of gold's more richly valued position relative to where it's been recently.
Yeah, and that's typically how bull markets work in precious metals. Is gold moves first, then you get a move in the big quality gold mining stocks, Agnico Eagle, Wheaton Precious, things like that. And then the more speculative components of the precious metal sector rally last. So that would include silver and then the more speculative mining stocks. So silver, as your listeners know, is the only commodity on the planet that's trading below where it was in 1980, which is pretty remarkable. So the upside potential, I think $50 has a magnet on it for fundamental reasons and technical reasons. Quite possibly this year. I don't want to make like too bold of a prediction, but I don't think that's too outlandish at all to say $50 silver. I mean, the metal traded there 40 years ago, 47.
Yeah, in fact, I want to interject right there that we just did some interviews, for example, with Lobo Tigre, where we were talking about the inflation-adjusted high for silver. And you could argue all day about which numbers you're going to use for inflation because that will strongly influence your outcome. But even just using the CPI, which is far conservative compared to what John Williams from shadowstats.com has alerted us to. He said you'd have to surpass $400 just to be regaining the equivalent inflation-adjusted high from 1980 of $50 silver. So,
yeah, I agree. And yeah, Lobo's an excellent analyst, and I agree with him on most things. So yeah, the point is $50 silver, I think, in the fullness of time, will eventually become major support. And I think we go much higher than that. How high? Pick your number, but I think it's a lot higher than 50. But hey, let's get to 50 first. I think a lot of us who've been in this for a long time, we'll be happy when we get to 50.
So tell us what you're seeing on the silver chart right now, then what you're keeping an eye on.
So just like gold, $2,000 was major resistance in gold for a long time. Back in 2011, we got up to almost 2,000. Then again in 2020, 2035, I believe was the number in gold. Finally punched through it last year. Well, that was like a major breakout in gold. Well, in the same way, $30 has acted as major resistance for a long time in silver. Well, we finally punched through it this past fall. And then whenever you get a major breakout like that, it's very common to come back and back test it as support. So we broke out above 30, ran up to 35. And now what this looks like to me is a breakout back test. So for me, I view anything between the $20 and $30 range as a very attractive place to accumulate or increase my dollar cost averaging. Now, because silver is so volatile, I mean, sure, it can overshoot for short periods of time. And I think 2640 here has been a very key level. I mean, you don't have to have a degree in technical analysis to be able to see this support line right here is very key. So again, if-then statements for me, if we pull back to this $20 to $30 range, to me, that's a great spot to accumulate. But 2640, I mean, if that presents itself, for me, I'll be buying pretty aggressively down there. Not predicting that it goes there, but if-then statements. Conversely, maybe if I'm not selling any physical metal at 35, but silver miners and things like that, if we run back to 35, might take a little bit off the table while holding some for a run up towards 50.
In addition, the other silver metal that we often like to talk about is platinum and the palladium. Are you also watching the platinum palladium group? And any particular thoughts on those at the moment?
I am, yeah. I mean, I watch platinum a lot more closely over the last year or two, just because platinum is so undervalued relative to palladium, relative to gold, relative to silver, really relative to almost everything. Platinum is just historically undervalued. I don't have to pull up the chart now, but the vast majority of the time, platinum trades at a premium to gold. It's more expensive. Someone did a study a couple of years ago. I wish I could cite them. I just don't know who, but I think it was like 86% of the time over the past 50 years, platinum traded at, this exorbitant premium to gold. I wish I could remember the exact numbers, but it was a very small percentage of the time, like minimal, like 1 or 2% of the time that platinum trades less than the price of gold. And that's where we're at right now. Platinum's down at like 1,000 and gold is up at 2,800. This is a historic undervaluation relative to gold. So as a contrarian, to me, platinum makes a lot of sense to have some exposure. And for me, I put 20% physical platinum in my long-term physical metal portfolio. And there may come a time where I can swap some of that platinum for gold down the road when that ratio normalizes. But from a technical perspective, you've got this big long-term triangle pattern right here. And we're on we're approaching a decision point right at the apex of this triangle pattern. Something I believe big is going to happen in platinum. Could it be to the downside? Possibly. I think I have a very strong upside bias, let's put it that way, for fundamental reasons and technical reasons. When we break out of this, I can see a really big move in platinum.
One more metal that doesn't get discussed as often, but when it does, is usually very strategic and geopolitically sensitive as well, is uranium. Rick Rule has been telling us to keep our eyes on that for years. Lobo Tigre also discussed it. What are you seeing in the uranium space right now?
Well, the fundamentals, it's one of those sectors where the fundamentals just continue to get more and more bullish, yet the price action has not quite or fully reflected that yet. And as a contrarian, I like that. I like that when price and value diverge. Now, markets very often, most of the time, are efficient. Price fairly accurately represents value, often anyway. But I think that's probably not the case right now in uranium. I think it's very undervalued. The world is going to need a lot more uranium. The world is turning towards nuclear, and this latest, demand from these AI data centers down the road is just icing on the cake. There was a bullish case for uranium even before all this. But look at the price. This is the Sprott Physical Uranium Trust. So it's a nice proxy for the price of the physical metal. You can look at the futures price as well, but it's very thinly traded. So I just like to use the Sprott Physical Uranium Trust. Physical Uranium Trust. And you can see it got up to $25 and pulled back to as low as 16. That's quite a sell-off here, all in the confines of this very bullish triangle pattern. Now, again, if-then statements. To me, I could label this the stink bid uptrend line. Not sure we're going to pull back this far, but if we do, man, to me, that would be a fantastic entry point. I'm scaling in here, to be honest, right along this $16, $17 area. That's good enough for me, but keeping some cash available in case we pull back a little bit more. Once we get above this upper rail, this clear resistance line, I think that opens up that makes the path of least resistance a run up towards 25. And that's in the physical metal. The mining stocks look very compelling here as well. This is URNN, the Sprott Uranium Miners ETF. And here's that primary uptrend line going back to the fund's inception. And every time we pull back to here, sentiment's down in the dumps, people are frustrated with the sector. Well, that's when I like to scale in. And you can just see how well technicals have served me. Very simple technical analysis, scaling in on pullbacks to this support. Now, of course, no guarantee that holds, but the risk-reward ratio is in your favor, buying on pullbacks to support, as opposed to, buying when everyone else is all bullish, on these big rallies.
Just a curiosity question again for you and your technique that you use when scaling in, when you're down at a support level. Do you tend to actually place low ball or stink bids that are low enough that you may just grab something intraday that will be what you're looking for? Or do you actually wait until you see a rebound off of that level, sometimes for 1, 2, or 3 trading days or whatever, before you make your move?
Yeah, such a good question. And there's no right or wrong with that. Because I watch these markets all day long, I don't just place stink bid orders to be out there. But for the average person who has a real job and a life outside of these markets, which I hope most people do, that's a great technique. So you might say, I don't know, just pick a number here, $39. If it pulls back to 39, I don't think that's going to happen. But if it does, you can just place an order that's good for usually up to 90 days. For your shares. And if price spikes down and then rebounds, you get to, accumulate those shares and you don't have to sit here watching it all day. The other question was, do you wait for a rebound? That's a more conservative way to do it. And a lot of professional traders do that. They'll look for the back test of support and then look for price to begin to rally off and then they'll buy. Now you give up a little bit of, you're not buying the exact bottom, but you have more confirmation and you're more likely to be right. So that's personal preference, but I don't personally do that.
Less likely to be catching a falling knife, as they say.
Yeah. And Steve, I'll just say one thing on that. That's why it's, as a speculator and trader, like I speculate in things that I have a deep fundamental conviction in. So with the falling knife, let's just say I buy it and it just keeps going down, which happens. Well, because of my fundamental conviction, I'm okay with holding that. It's just going to take longer for, those upside targets to come to fruition.
You've given us a quick whirlwind overview of gold, miners, silver, platinum, uranium. Anything that we missed that you feel is an important part of today's story that you're watching?
No, not really. I mean, I'm watching interest rates because I find it very interesting right now that the Fed is lowering rates, but yields continue to rise. And I think we've all known there's going to come a day where the Fed kind of loses control of the bond market, where they go to cut rates, but the market responds in the opposite way that they intend. I'm not 100% sure we're there yet, but we're seeing some signs of that, especially with, that 10-year rising while their Fed is cutting. So that's something to watch closely, because if the market loses confidence in the Fed, that could accelerate kind of the end game faster than many might think.
If people want to stay apprised of your latest thinking on all of these matters and get guidance on a more frequent basis than your visits here, where should they get connected in?
Sure, silverchartist.com. We've got a really great community. It's a fully transparent, over-the-shoulder service. I don't claim to be perfect. I make my share of mistakes, but I do that in a transparent way, and hopefully that helps our members to make better investing and trading decisions.
We've been speaking with Steve Penny, the founder of silverchartist.com. He's a supporting sponsor of Liberty and Finance. We're grateful for that, Steve. And once again, as always, on behalf of all of our viewers and subscribers, thank you for joining us on Liberty and Finance.
You bet. Thanks, sir.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 20th through January 27th, 2025, while supplies last. This week we feature the 1-ounce Canadian Silver Falcon coin at just $2.75 over spot, the lowest price we've had on any sovereign coin in years. We also have 90% constitutional silver or junk silver at just $1.69 over spot per ounce. We also have the 1/10 ounce UK Gold Britannia coin at just $29.99 over melt. And finally, 1-ounce gold Canadian maples are just $59 over spot. Again, one of the lowest prices we've had on gold sovereign coins in years. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.